We've been talking about M&M. We've also been talking about the IT space doing really well. So let's get you some more excerpts from our exclusive conversation with the M&M Group from the investor meet. Nigel and Surbi caught up with the top management of M&M to discuss the group's ambitions for its technology and finance business, Tech Mahindra and Mahindra Finance. Listen in.
Just about a month and a half back, we laid out a very comprehensive multi-year plan about where we plan to take TechM. We spoke about our plan for revenue, we spoke about our plan to improve productivity and to improve margins. But most importantly, we spoke about the plan for the organization, right? We're not looking at 1 quarter or 1 year, we're looking at a multi-year plan, right? So to really create an organization that goes toe-to-toe against the best of international competitors and wins, I feel we have a comprehensive plan, including more than a 500 basis point expansion plan.
And by when? So I'm sorry, but allow me to get into small nitty-gritties over here. The reason we sort of ask you this is that the environment, as a lot of your peers also tell us, perhaps still hasn't changed. You tell us what you're reading in terms of demand growth, in terms of any acceleration or pickup in spends. And in how much time do you think you can achieve this 500 basis points margin expansion milestone?
So I think what we've spoken about the fact that we will deliver a 15% EBIT margin by FY27. And so that is the plan. It's a 3-year plan. Again, I'm very reluctant to give, quarterly or near-term targets because there is a lot of volatility, right? And because, as we've said, we're in the middle of a turnaround story. In the first year, you should expect volatility. You should expect us to go, 2 steps forward, 1 step back, because that is the nature of the business, right? We're also investing heavily in the business to create the foundation for long-term success. But we've given a very clear expectation of where we expect to be from a growth perspective, from a return on capital perspective, from a free cash flow perspective, and from a margin perspective by FY27, and to build to build on what already is a world-class franchise.
Well, Mohit, let's push you a little bit on that point then. In terms of margin improvement, I think you're looking at also leveraging group synergies. So tell us, how much is that going to contribute in terms of this entire improvement? And also in terms of a revenue mix, what about the diversification away from the telecom space?
Sure. So I think, look, we're not looking at group synergy to deliver margin improvements. What we're saying is the group is such a wonderful asset for us. Right? It really is a force multiplier for us. So I think of group synergy in 3 different themes, right? The first theme is, how do we deliver services to the group? See, the group is increasingly, every single offering or product the group has will increasingly have technology as a larger component. So to that degree, technology is the golden thread that runs across all the Mahindra businesses. How do we work with the auto business? We already work very closely with Rahul in the financial services business. So how do we serve these businesses best as a preferred supplier from a technology perspective? The second piece is the Mahindra Group has a wonderful set of ecosystem partnerships and relationships across the world, whether it's in Japan or in the US or all parts in between. There are very strong supplier partner, ecosystem relationships that we can leverage to, to build our own TechM business. But the third part, which is the most exciting, is how do we build, platforms for the future using Mahindra know-how and TechM technology expertise, and maybe a third party as well, right? How do we work with the hyperscalers, the chip companies, to build platforms that are truly next-gen? So the Mahindra synergy is not about cost savings. There will be some elements of cost savings as we ride on a common infrastructure for procurement, for instance. But the synergy is really about serving the Mahindra Group effectively, using the ecosystem and the supplier relationships to build our business, and about building next-generation platforms really, for the industry. From a growth perspective, look, again, we've said we want to retain our leadership position in telecom and manufacturing. There is no stepping back from that. There is no road to Tech Mahindra success that does not go through, success in telecom and success in manufacturing. But I also believe that we have the capability and the opportunity to be really a very credible challenger from a financial services perspective, from a healthcare life sciences perspective, maybe from a retail perspective. So those are things that we will use to build the business as we become more scale in those industries. But we're not stepping back from telecom or manufacturing.
All right,
I'll just add to the group synergy part, which is we want each of our businesses to be tech leaders in their industries.
Okay.
And this is where TechM is a huge asset for the group. Yeah. Not just for Gen AI, which is more recent, and we've got multiple initiatives around Gen AI, but looking at every single technology, looking at quantum, looking at metaverse, there are multiple opportunities across the group to create use cases at scale that TechM can take to its customers. So therefore, there's a huge benefit to be able to leverage this synergy.
Is there a number that you could share as you go through this whole turnaround process in terms of just revenue breakup, let's say by FY 26-27? How much would be group and non-group?
Well, I don't expect that the direct group revenue component would be very significant, to be honest. It will be meaningful, but not really significant from a revenue perspective. What is more important, I think, is the level 2 piece, the partnerships the group has, and the level 3 piece, using the group expertise. Like we spoke about the factory of the future today, right? The hyper-connected, hyper-automated factory of the future that we have already built in Chakan, right? So to showcase that, to build next-generation platforms based on the IP that we already have built for the group.
Okay, all right. Let's get Rahul into the conversation then. Rahul, the street is quite bullish on prospects of Mahindra Finance. So delivery is going to be very, very important. Give us a couple of numbers. The credit cost guidance. The market's looking forward to some kind of reduction on that front. So could you tell us the timeline and where does that number head to? And on the cost to, the cost ratios as well. That's relatively higher. If I compare the cost to income with some of the peer group, it's a little bit relatively higher. So guidance on both those two, credit cost as well as cost to income.
Sure, thanks Nigel. Thanks, it'll be great to be here. So on the credit cost, you're right, we've been slightly higher than the peer set. And if you just watched us for the last 2 years, I think we've been trending down, right? Yeah. And even the inter-quarter volatility has been largely addressed. We closed last year at 1.7. We've historically, if you look at credit costs, it's a summation of provision and write-offs. Yeah. What's really coming down is the write-offs. That's the actual loss. It used to be in the 2.5 range. That number's really slid down, which gives us confidence, and it also gives us a reflection of the underwriting we're doing for the new book, because the stage 2 and stage 3 are at record low levels. We closed at 8.4. If you even wind back and look at the previous benign seasons, we were never at those levels. So structurally, credit costs is slated to go down because the stage 2 and stage 3 composition itself is shrinking. What's happening behind the scenes is a lot of grunt work on underwriting, on asset quality, the kind of assets we're selecting up front. So this is something which is trending well and which will hold us in good stead for the future.
So declining credit costs, what about the cost to income?
Cost to income, see, we were at a very sweet spot. We were in the low 30s, and now a couple of years we've been in the mid 40s.
Yes.
We're kind of putting a very high bar to get back to the mid 30s in the next 2-3 years. The complex thing is that when you're in a transformation zone, you're investing heavily in technology, you're investing for growth also in distribution, so you don't want to be penny-wise, pound foolish. We've been investing in the last 2 years in possibly tech, digital, which we have not done for the previous 7 years. So that's cost upfront, but that will really drive a lot of growth for the future.
If you want to give us a number on the credit cost number, the cost to income we got, it comes back down to the mid-30s in the next 2 to 3 years, as you explained to us. The credit cost, you want to give us a number?
See, I can give you range numbers because, this is a business which is a high-NIM business, right? And our business models includes funding new-to-credit customers, close-to-prime customers. So we do have a higher NIM to absorb anywhere between a 1.2 to 1.5 credit cost.
Okay, 1.2 to 1.5. Rahul, I want to talk about growth. As you see, not just this year, but perhaps another year or two down the line, what is the growth in the book that you will set out to sort of aim for? If you could give us some range, that would help. And also segments. Housing has been a big segment for you. Is it going to be more finance? Which sectors are you going to target over the next 1 to 2 years?
Yeah, so if you've watched Mahindra Finance, we've had our moats. We have a lot of strength in the wheels business. Even today, it's 94% of our business. We think that diversification is required. We've just crossed 1 lakh crores of assets under management. So the real growth going forward will be, or the themes would be, to protect market share in wheels. We are sitting at a position of strength. We need to protect that. We've got high market shares across the wheel segment. We are looking at growing 2 more meaningful segments, the SME and the mortgage segment. And these 3 segments constitute 65% of the retail lending anyways. Both the mortgage and SME are relatively new, so it is going to be a lot of focus and execution going forward. Growth, if you look at these 3 together, have been growing anywhere between 12 to 15%. It's really the unsecured growth which has been high of late. So we are fashioning for the same growth as industry in wheels, but our growth in mortgages and SME will be much higher.
Dr. Shah, we have the tech head as well as we have the financial head. They're both talking about growth. It's organically, right? Any inorganic growth plans on either of these two?
No, there may be some tuck-in acquisitions from a TechM standpoint for some capability building, but the primary focus is going to be core execution. And both businesses are very well set up for that, as you heard from both our leaders, and we feel very bullish about them.
In terms of just what's the chatter out there, everyone in the market has been waiting for a pickup in IT spends, better environment, better mood. Is any of that around the corner?
I think things are certainly looking better than they did, a year ago. And from our perspective, look, we have a new strategic narrative of scale at speed. We have reorganized the organization. So we also have our own internal tailwinds working for us. But I would say that it's less dire than it was a year ago. And it certainly seems like things are going to...
Okay, so things looking better on IT spends. That's Mohit Joshi giving us a lowdown on Tech Mahindra. And of course, we had the officials from Mahindra Finance as well spelling out the strategy on the lending side. With that, we do have to take a very quick break.